Welcome to Founding Fathers Financial Freedom. Today we're going to look at one of the oldest institutions in the U.S. from an economist's point of view. Economists view life insurance as a valuable social institution. Let's face it, there's one guarantee in life. What is that guarantee? The one guarantee is, in fact, change. We face a myriad of hazards in life, and life insurance allows us as a community to suffer the loss evenly rather than concentrating on a few unlucky members of our group. Collectively, life insurance gives us peace of mind knowing that our families and the things that we cared about are protected. Welcome to the iconic journey into the world of whole life insurance economics. This presentation will explore the core economic principles that underpin the life insurance industry. From risk management to investment strategies, we delve into the intricacies of actuarial science, woohoo! The role of market forces, the impact of government regulations on the industry. And we're going to start with the history. Because why? I want you to know what the foundation is. What are we talking about? The historical foundation dates back more than 200 years ago, before we were established as the United States of America, all the way back to the late 1750s. It started with the Presbyterian Minister Fund, and this pioneering organization laid the groundwork for what we're going to talk about today, the modern life insurance. It provided the financial protection for the clergy's families. In the 1800s, life insurance experienced significant growth. Companies began offering policies to the general public, and a new type of coverage emerged to meet the diverse needs, which we're going to cover today. The period saw the rise in the mutually owned companies, which we're also going to cover. We're going to talk about companies that have been profitable every year that their doors have been opened, which ranges from 100 to 175 years, depending on which company we're talking about. And we're going to talk about the sophisticated actuarial practices, but we're going to make it simple. As always, I want you guys interactive in the chat, taking notes and sharing any takeaways you have with each other. And then in the 1840s, a landmark law in New York passed, marking a significant milestone in the history of life insurance. Legislation allowed women to insure their husbands' lives. It recognized the economic value of the spouse's life, and it granted the women more financial agency, which is what we're talking about at the end of the day, is protection and control. If you take nothing more away from this lesson than protection and control, then it was well worth your attention and focus. Now, let's imagine life insurance. Before we dive into life insurance and the money behind it, let's look an analogy. Let's talk about a group of people. Let's imagine a scenario. Imagine some neighborhoods around you where thousands of families live, and let's just imagine that all their homes are equally worth $300,000 apiece. Imagine this community where each homeowner pays a small annual premium of, say, $310 to a collective fund. If one of their homes burns down, the fund will protect this family's loss, keeping it from being a total catastrophic loss. Like, yes, they're losing tons of things, but now that small $310 amount that they paid has given them back the $300,000 that they lost when they lost their home. And this principle is called pooling risk. And it's comparable to how life insurance works. By sharing the risk in the community, each homeowner is contributing a small amount to protect themselves from a large financial catastrophe. This arrangement is inherently rational because the individual cost of the buyer insurance is far less than the potential loss, making it a wise investment for our peace of mind. We're talking about the law of large numbers. It's pulling the risk together as a community. And I think the more global we get, we miss the simple principle of it's really about our community and what we're building together. And so when we look at the power of risk pooling in life insurance, what are we talking about? We're talking about the rock solid financial tool of life insurance. It has the shared protection, which allows many policyholders to share the financial risk of unforeseen events. It creates a robust safety net, a guaranteed net for all of the participants. It gives us financial stability. It spreads across the risk across a large group, and it allows the life insurance companies to maintain financial stability year after year after year, ensuring their ability to be able to pay the claims. And then we have the community support. The risk pooling also is the principle of mutual support, where the contributions of many benefit those in need, strengthening community bonds. Think how often, one of the things that we believe is that we want to give back. It's one of our needs. We want to tithe, we want to give, we want to donate to others' cause. In a way, life insurance is doing exactly this, because we're protecting people we might not even know from when they have their worst moment. They're made whole again, and their family is able to survive and maybe even thrive with that breadwinner or that loved one that was insured gone. And what this risk pooling does, it also keeps the premiums affordable. Back to the fire example, the home example, if it was only 100 families, well, it would cost a lot more than $310 for the insurance company to be able to have enough for when that one moment happens. So the collection nature of risk pooling allows more affordable premiums, making life insurance accessible to a broader range of individuals. So far, keeping this pretty high level, pretty simple. Let's talk about what an actuarial fair premium, and yes, I took time practicing how to say that, by the way. Let's talk about what an actuarial fair premium looks like. The easiest way to understand whole life is to start with a much simpler term life policy. We're always talking about specially engineered whole life. Today, I want you to we want to work from what the insurance company is looking at. What are they thinking of when they're offering us to be a partner in their company? So let's examine this from a perspective of the whole life company. Keeping in mind, a life insurance contract guarantees the insured to pay a tax-free death benefit to the beneficiaries that were named in that contract. It's a contract. It's an obligation that the insurance company is entering a contract with the policy owner, where they are guaranteed, if in event of your death, your beneficiary will be paid, right? So from the life insurance point of view, they want to know what's the break-even point. And this is the actuarial fair premium is the break-even point for life insurance. It's where the premiums collected exactly cover the expected payouts and administrative expenses. And it's a delicate balance that ensures that the insurer remains solvent and can continue providing coverage year after year after year. And this is why the first thing that we teach is thinking long term. And our partners must think long term in order to serve us and our family and our family's legacy and those that we love. So who are the actuaries? Like, who are the people that are brilliant enough to come up and know almost to the minute when you and I are going to pass away, where we're going to graduate, where we're going to die and no longer be here? Well, the actuarials analyze the financial costs of risk and uncertainty. They use mathematics, statistics, models, financial theory to assess the risk of potential events. And they help businesses and clients develop policies to minimize the cost at risk. Actuaries' work is essential to the insurance industry. So when we think about it, it's pretty amazing that they can narrow down. Like, do you guys think that's amazing? Can I get an I in the chat? If you guys are still awake, can I get an I in the chat for anyone who thinks it's amazing that someone could look at your profile, your family history, and literally be able to say, within this year, this many people of this age group are going to pass away, and their beneficiaries are going to receive that tax-free benefit. And the actuaries actually use, like I said, sophisticated statistical models. They're carefully calculating the premiums based on factors like the mortality rate, the investment returns. We're going to assume 5% for the insurance companies year over year, and the operational cost, right? The cost of running their mutually funded company that's a dividend-paying whole life company. And they can predict the average lifespan of people with similar characteristics and use that information, as I was mentioning, to estimate the likelihood of the death claim. And so the premiums are set at that level break-even point for the expected payouts, expenses, and a reasonable margin of safety. So let's look at some of the actuarial promise, the cost of the assurance, right? The cost of this policy. So life insurance pricing is a science. It's not a guess. That's where we're going to start. It's not a guess. And remember, we want to know that we're in control of what's happening in our lives. We want as much control, as much certainty that the things that we want to happen are going to happen. And we are guaranteed that things will what? Things are going to change. Always. So this complex formula, I put some of it here on the chart and just showed you from now this is older information. This is using a 2001 model, the CSO mortality, and this is from the Nelson Nash Institute, is where I developed this little chart I made, and they factor the mortality of the insured. The younger and healthier the insured, the lower the risk and therefore the premium. Remember, we're talking about term policies right now. So we're looking at a level premium on a 35-year-old healthy, non-smoking male. So look, at the 5-year term, the mortality per 100 people is 1.7. So almost 2 people are going to pass away out of that 100. The level premium for the insurance company to pay out that $1 million guarantee if those 2 people pass away, that's 2 out of 100, is $954 per year. That's the yearly cost, the level premium. Per month, that is $79.50. So total for 5 years to protect your family, God forbid something happens, for $1 million is $4,770. Now, insurance companies know this, that level premium, that cost, the actuarial information, statistical guidance they're using. They know that this is likely to happen less than what? Less than 2% of the time. 2% of the time. And we're assuming in my scenario that the life insurance company is earning 5% on the premiums, because remember, they need to have the liquid pool of money from an Austrian economist point of view, where it's dollar for dollar backing the money. So let's look at what happens if it's a 10-year term and it goes out to year 45 for that same healthy male. Now the cost has gone up to $1,378 because now why? We have 2.7 or 3 individuals out of 100 passing away. If we go out to a 20-year term, now it goes up to $2,184, so a little more than double, right? We added 15 more years, the cost is a little higher because now we have 4. So that means, what does that mean to the insurance company? It means that they are paying out $4 million of that group guaranteed to the family to make them whole. Again, remember the risk pooling that we're talking about earlier with the fire example and just with risk pooling in general. We're protecting the community. We're protecting people that are just like us because we're all the same. We're all the same, whether you, like everyone here, Stephen, Anthony, Brenda, Derry, Frank, Gloria, we're all the same. And then we look, now this is an 86-year term, which there is no such thing, I guess convertible terms, but 86 years. Why did I use 86 years? Because that brings us to 121 years old. Most whole lives are through 95, 100, or 121, just depending on the mutually owned company that's offering that particular product, we'll call it, that particular process for somebody. But so then look at the cost there, $8,225. I mean, that is over 9 times more, over 9 times more than a 5-year term. And so people might look at that and say, damn, that's expensive, Jason. $8,225 a year or $685 a month for a term. And when I was thinking through this, I said, okay, well, let's do the math. If we pay that premium for all 86 years, say you live, you're 120, right? Technology, biohacking, it's all making it possible for us to live much longer and live a higher quality of life at the same time. The total premium deposits paid into that term, right? Remember, we're just talking term insurance, so the only thing this is protecting is your life and the guaranteed death benefit for the family and the ones you love or the cause you love. The total cost for 86 years is $699,000. The guaranteed tax-free benefit is $1 million. So there's a 100% mortality guarantee of that. And what we're talking about is showing you the reason why as we get older, as the likelihood of us graduating, no longer being here, goes up, that guarantee contract that you've entered with a life insurance company, the risk is going up to them. So what do they have to do? They have to keep the level premium at a point where we're risk pooling in an equal manner that everyone is made whole again. Are you guys following? Can I get a yes in the chat if you're following how this works so far? And the reason I use the 86-year example is because that brings us to whole life. And we start looking at, okay, whole life for a $1 million policy, $8,225 a year. Now these numbers are older numbers, but it's just an example so you guys can see what it looks like to have an actuarial fair premium to meet the expected death benefits and the risk the insurance company is taking on every time they enter a contract. Now, when term contracts are up, what happens? The person has to reapply because you're covered for a term, whether it's 5 or 10 or 15, 20, 30 years, are typical term policies. And terms are amazing. They're amazing policies to protect your family just in case you're one of the unlucky that happens to graduate, to die early. And so you might say that, wow, it gets more and more expensive, but is it really getting more expensive? Or is it really giving you that peace of mind that you are covered for more? And so let's look at this from, some people might say, well, you're just gambling that you're going to be one of the ones that die. So, what if you're not one of, if you go back to the 35-year-olds 5 years in, you're not one of the 1.7. Well, you're betting that you're one of the 98 that's still alive. And so even though insurance and gambling may seem similar, they operate on fundamentally different principles. Think about this. Gambling involves a calculated risk with uncertain outcomes. Insurance, because of the actuaries and the science, aims to do the opposite. They mitigate their risk by spreading them among a large group. And the concept, again, is risk pooling. It allows individuals, what's happening? It allows individuals to share the potential losses of a few of the community, ensuring financial protection for all. So you see at the top of the pyramid is insurance. It's protecting us. It's giving us certainty. It is ensuring financial protection for everyone that's involved and able to do this. It's a gift. The risk pooling, predictable premiums, and then you go down to gambling at the base, where conversely gambling involves a bet with an unknown outcome. If you go spend $1, buy a lottery ticket, you have 1 in a million chance, you're leaving yourself vulnerable to the loss. Like you have very little chance, 1 in a million, that you're going to win that $1 million. Whereas life insurance, you statistically know that at some point you're not going to be here anymore. And if you guys know some way to continue on, to live longer, to do all the things without cryo-freezing ourselves or something crazy, let me know. I want to know about it because I haven't discovered that yet either. And when we look at our future, when we talk about securing the future, the insurer's promise, what that contract that you're entering into, if you're so fortunate to be approved, is that he or she who has the gold makes the rules. So we talked about term insurance as a way to introduce what life insurance is doing. So life insurance, whole life, is doing what? Just like the name says, it's protecting your whole life. and the insurance companies taking the premium deposits that we are depositing into our insurance, and they're generating returns. They're putting it into safe investments to make a spread on that money, the same as what we teach you with infinite banking. This builds their secure financial base, and this is how they're profitable, because they're not practicing fractional banking. And it enables them this safe base, this pooling of risk, and having a large enough, the law of large numbers enables the life insurance companies to fulfill their commitments every single time to the policyholders. And the cash surrender value in your whole life is a safety net for policyholders that want to discontinue their policies. It represents the portion of the premiums paid. And the feature, even though I wouldn't recommend cash surrendering, it's nice to know that when you're putting the money in there and it's growing at a guaranteed rate, you can gain back that money that you've put in there with a higher degree of financial stability. So let's look at the guaranteed growth, the conservative approach. Again, I'm super risk adverse. So are you. You're here because you are also risk adverse, I imagine. You're watching this because you want to understand the principles and the economics from an actuarial standpoint. I'm keeping it super high level, not going into a lot of detail, but whole life policies, as I've been saying, offer a guaranteed contractual minimal growth rate. Does that sound good to you guys? Who wants a guaranteed amount, whether it's 2% or 3.25%, that they're going to get year after year after year of compounding interest? And again, these mutually owned dividend paying whole life companies have been profitable every year they've been in business. Think about that. I'm going to show you some of the things that have taken place since the 1900s here shortly, but think about being profitable during the housing bubble and recession of 2008, the dot-com crisis, coming off the gold standard, the Great Depression, World War I, World War II, the Vietnam War. Just think of all of the things that have happened and having that economic stability, profitability, year after year after year. That is a well-run machine. And the companies we partner with, they're investing in a diversified portfolio of assets. They're ensuring the stability and the long-term returns. They keep a small portion liquid, like a bank, where they can have the money to pay out these guaranteed death benefits as well. Again, it gives us that predictability, the control, and the peace of mind. And when an insurer's investment performances exceeds expectations, the policyholders get what? They receive a dividend. And since these have been profitable every single year, policyholders are getting a dividend that reflects this positive outcome. It's a win-win. It's an everyone thrives situation. And the dividends can be used for a number of things. Now, we use them to buy more cash value, more death benefit, but they can be used to pay the premiums, they can accumulate cash value, they provide a tangible benefit for the long-term planning that we're teaching you guys. And so remember, this is a social institution that's beyond the economics. It transcends mere financial instruments because we're teaching you a process. And we're going to show you some of the historical numbers here in a second. We're going to show you how this gets the community-wide security. I'm going to talk about different vehicles that are available. And we're going to look at the differences. Just quickly, we're going to take a quick glance, look at the life insurance in the context of our United States financial history. 1913, the Federal Reserve was put in place. We were the last of all the major companies. We talked about this previously, but it was a milestone in our U.S. financial history. As a central bank, it aimed to provide a safer, more flexible, and stable monetary system. Whether we believe that's happening or not, that's another topic, another day. But its development occurred decades after life insurance had already become an established financial base for families. It highlights the enduring nature of life insurance in the American financial landscape. Look, we have the ratification of the tax code as we know it, the tax system, and then the Tax Reform Act in 1973. All these things have happened over 50 years ago, 50 years, 100 years or more ago. But life insurance, like I mentioned, has been around before our country had a Declaration of Independence. Think about that for a moment. That's when we talk about the wealthiest families, the Rockefellers, the Rothschilds, the Morgans, the Stanleys. We're talking about families who understood the value of long-term thinking. That's really what we're talking about. So let's look at the evolution of the life insurance as a product, right? So 1830s, lifetime coverage, whole life, again, whole life, fixed premiums, cash value accumulation. And then in the 1860s, to give more people accessibility to protect their families, there became term insurance, which was lower, and you guys saw why, lower cost, no cash value accumulation, but protected the family, a guaranteed protection in the worst case. Then in 1979, think about the times, we're off the gold standard, we're coming up with qualified plans, we're introducing all these new financial vehicles. Now there's universal life insurance, and what did universal life insurance come to do? It's tying insurance to the market in temporary coverage. It gives us lower premiums, no cash value, but it's tied to the market. So secure, you guys decide. Market, secure, I'll leave that up to you. Variable universal life, started in the 1980s. This is an investment option for cash value. Again, it has a potential for higher returns. We all love potential, especially entrepreneurs, creators like yourselves, people that are really in that 5% here investing their time. But do you really want potential returns, or would you rather a guaranteed on your contract? Then you got index universal life. Don't get me started here, but to be fair, we wanted to see, could we tie the market growth in a good market where year over year you have a higher return, so you have the ceiling, and then you have your floor to mitigate, protect you from risk, but it's tied to the market performance, and the insurance company is in control of that contract, which most people miss. They don't understand that the insurance company can turn down the ceiling and turn the knob to turn down how much that person is receiving as far as the percentage goes. And then in the 80s, we have R. Nelson Nash. The book's right here next to me somewhere. Here we go. Brilliant book, right? Changed my life, changed my family's life for generations to come. But we have specially engineered whole life policy, which is what this channel is typically talking about. But today I wanted to give you more historical information so you guys could really understand the economics of life insurance from the insurance company's point of view. And we look, again, we talked about the rising cost of term insurance, right? It rises because of why? Because more people are going to die, and the insurance company is on the hook, if you will, to pay out more guaranteed death benefits. The premiums are calculated again to reflect the actuarial tables, the probability of different death at different ages. People age, the older we're getting, the premiums increase accordingly. Cost of living also plays a role in this. So as inflation goes up, the purchasing power of our money goes down. So the premiums are adjusted to show this. And bringing this full circle, we're really looking for the win-win that we're sharing today. We're talking about, again, this is a shared risk pooling of a community. We're protecting each other, those that we love. It's a positive sum win-win scenario. This voluntary, remember, life insurance is always voluntary no matter what type of insurance that you're picking. But it's a voluntary transaction where individuals pool their resources to protect against financial losses. And this, by participating in this arrangement, everyone's benefiting. Through the insurance, individuals can reduce their exposure to financial ruin, to change unforeseen things, and allows them to focus their resources on other priorities to making a difference in the world. Because they know they're protected. When you know you're protected, you're more often in the gain. You're able to think abundantly. You're able to look at what's possible versus worried about what might happen or will happen at some point. So it creates more prosperity for everyone. And the premiums, again, paid, think of them again as deposits. They create that pool of funds used to cover the cost of the claims. They ensure that everyone who participates in these mutually owned whole life companies benefits from the shared risk, and it creates a positive outcome. Again, it's about long-term thinking, shared financial responsibility, community stability, generational impact and charitable giving. If you are like some, where maybe you don't have kids or grandkids, what's something that you care about, that you love? You can leave the money, the tax-free money, to that thing. So when we look, let's leave you, we've covered a lot today. Life insurance is the cornerstone of our economic and social stability. It's simple. It empowers the communities. It mitigates our risk. It safeguards futures. From the individual perspective, a life insurance policy provides the financial security for dependents upon the insured's death, shielding them from devastating loss. And it plays this critical role in our stability in building a guaranteed financial bedrock for our family and our family's future. It all starts with really understanding life insurance, the economy of it, the actuarial science. So today we've journeyed. We went over 200 years of time in just 30 minutes and what it means to the community. We have looked at the basic economics from a whole life company's perspective, showed you how a guarantee is the exact opposite of gambling, how it's a contract with guarantees of what you want to happen will happen. Because remember, as far as I know, no one's getting out of this alive. You guys know any different? Let me know. I want to hear about that. But now you guys are much more informed, understanding the economics of life insurance. It illuminates its value in our lives. The journey toward a secure future has explored the principles of risk pooling, actuarial fairness, and the enduring promise of life insurance. We usually don't talk about this as the guarantee, but now we've seen how whole life insurance, term life insurance, all the other versions that tie to the market really come into play, when they started, how long they've been around, and just think of it through the long-term prism of a couple hundred years. Where do you want to be 100 years from now? You know, if you're still around, where do you want to be? Where do you want your family to be? Your family's family to be? We want to understand that this is nothing more than securing our community, our loved ones, ourselves, and giving us that peace of mind by being risk adverse. So let me know what questions you have. That is our journey today. Next week, I have some more. We have guests coming up in the future. We have all kinds of exciting topics we're going to continue covering, mostly tying it all to the infinite banking concept and the power of taking back control of your money. Because at the end of the day, what I want for every single one of you is more peace of mind, more financial freedom, stability, time freedom, and more love in your life. Let me know if you guys have any questions. Otherwise, I will see you next Thursday. And thank you guys again. If I didn't say it already, I'm super impressed with you giving your most valuable resource again to the Founding Fathers, to this presentation to learn more. It shows a ton about your mindset, about your belief in yourself. So just keep doing what you're doing and applying the actions. Today, we have journeyed through the economics of whole life from a life insurance point of view. We went through over 200 years of history of life insurance and what it means to a community. So if you're new here, go ahead and smash the like button, subscribe, and ring the bell. It might just turn blue for you. We've looked at the basic economics from a whole life company's point of view. We've showed you how a guarantee is the exact opposite of gambling. Understanding the economics of whole life insurance illuminates the value in our lives. The journey towards a more secure future has explored the principles of risk pooling, actuarial fairness, and the enduring promise of whole life insurance. We've seen how whole life insurance serves as a social institution that safeguards families and individuals from financial hardship. So I know you have love in your heart being here. Think about what you're doing, not only for your family, but for other families, by becoming part of this social institution that creates a guaranteed foundation for your family and a guaranteed tax-free future. Appreciate you being here. Watch my next video here, and I'll see you soon in the next video. Be blessed.